Good morning, ladies and gentlemen. Thank you, colleagues, for attending today. I'm representing North Star Asset Management, and I'm going to talk about flexibility in the markets that we have today. I'm going to start off with this quote from Swenson. Swenson ran the Yale Endowment Fund, $30 billion fund, 30 people, kind of the size of Coronation in South Africa with 30 people. And what he told us many years ago, he died in 2021, was that you need to be quite suspicious of your winners. And if you got a loser, you should be relatively hopeful. And that kind of, strangely enough, leads me into our next slide, which is a little bit around asset allocation. One you've seen so many times, but I'm going to make some highlighted points when we look at this slide. The first is that no asset class successfully produces the same return as it did the year before and ends up at the top of the slide. So, you know, an outperformer one year tends to be an underperformer the next. And then those that are the largest underperformers don't end up being consecutive underperformers the next year. That's one easy point to pick up. The next, of course, is that the underperformers, and if you look at 2017, very often become the outperformers of the following year. So US bonds, global bonds, US cash tended to be the best performing asset classes the subsequent year. If you look at REITs, you can see how they move from the lower bands right up to the top bands in the subsequent year. And lastly, US cash, which was a top performer in 2022, was an underperformer in 2023. Why are we telling you that? Because it's bloody hard to get asset allocation right. But it's equally difficult to get stock selection right, no matter what anyone tells you standing up here today. And Schloss is, if you don't know who that is, managed money for 45 years, regarded by Warren Buffett as one of the superheroes in this marketplace. He's actually a value investor. He compounded at 16% annualized against the S&P at 10. And he said something quite fascinating. We live in a society that changes, so you can't be too strict about the rules you applied in the past. Now, this was a stubborn guy. Buffett described him as stubborn. Yet he made the comment that you need to rethink the way you do things as time progresses. And that kind of leads me to the next slide. And hopefully they'll run them from the back. These slides demonstrate the changing capitalization of the top 10 stocks in the S&P over time. And you're not going to be able to follow them, but we'll talk to them just now. All right, stock persistency. Stock persistency is low, and I'll go into the details of that as we present the presentation. There were 33 companies, believe it or not, that you saw in that matrix. 33 companies that found themselves since 1973 to 2023 in the top 10 of the S&P. But what's interesting is 21 of those companies only made it into one decade. 13 made it into two, 8 into three stocks into 4 of those periods, 2 stocks into 5 decades, and only 1 stock made it all the way. And that's ExxonMobil, due to an acquisition. So what do I get out of that? If you bought the top 10 stocks in 1973, your top 10 portfolio would only have had 1 of them in 2023, which is an oil stock. The second point is that something's changing along the way. So in 1973, it was all about oil. In 1983, it was about industrials. In 1993, it was about consumer. In 2003, it was mixed sector leadership. In 2013, tech. In 2023, tech. And in 2024, tech. What's also interesting is why those stocks changed. And here's a little hint. I went back and looked at when they listed the stocks that represent the largest companies in the world now. Apple, Microsoft, Google, Amazon, Berkshire, Nvidia, United Health, J&J, ExxonMobil, and Visa. Believe it or not, 3 of them listed only in the 1980s, 2 of them in the 1990s, and 2 of them in the 2000s. So only 3 stocks, Berkshire, J&J, and ExxonMobil, would have been on your radar in 1973. The world changes, if we like it or not. So how do you deal with that? But before I get there, I thought this would be of interest. In 1973, I went back and looked at the headlines. The New York Times said on the 28th of October 1973, politically safe oil stocks win investors. Well, in 2024, not one of them was on the top 10. CNBC, 19th of February 2024, the so-called Magnificent Seven. The so-called Magnificent Seven now wields greater financial might than almost every other major country in the world. The question we should ask ourselves, will the Magnificent Seven still be there in 10, 20, and 30 years' time if persistency of history is anything to go by? So I'm going to get back to this slide. How do you solve the problem of what stocks to buy? And I'm not going to go into the detail of it, but I'm going to say a few quick things. We worked out, similar to the previous speaker, that returns on capital are important in companies. You give your assets to managers that give you high returns. So should we when we see companies. And we want the cash to come back to us as investors. So those are 2 things we look for. Quality businesses need to have cash, generative income statements, and they need to generate high returns when they invest. But if you add it to certain valuation criteria, what you tend to find is you buy quality companies when they're cheap, it outperforms the market over time. Over multiple periods, we've noted this to be the case. Not only does it outperform the market, but it caps your downside and increases your upside. So how does that look in terms of our own portfolios? So what we've done, and this is a complex slide, but I'm going to keep it very, very simple. On the left-hand side, you've got what's called NSGF. That's the North Star Global Flexible Fund. When someone fiddles on Excel, that's how they put it on there. And against that, you've got the MSCI All Country. And what we're trying to show is where our market, where we have exposure versus the market. So the far left-hand side, our fund has almost 15% exposure to very large companies. And then as we go further right, its exposure lifts in the mid area of the market. As against the index, it's heavily weighted towards larger businesses. If we look on the right-hand side, the Magnificent Seven in red, we've got very small exposures to the Magnificent Seven. In terms of the world's top 10 companies, we also have low exposure. But if you look far right, our total portfolio is represented only 16.9% in terms of market capitalization in the MSCI All Country. What we're telling you is we're buying the companies that are on their way to being super great, huge. We're not buying those big ones with relatively low persistency. Just in terms of asset classes and flexibility. So we've dealt with one thing, equity, the need to be flexible in terms of your equity exposure. The second is your asset class flexibility at this point in time. What we show here is if you went to bed in 1990 and only woke up in 2023, what would be the perfect portfolio to have owned? In the middle, we show the optimal portfolio would have had a standard deviation of about 11% and returned about 7% nominally an annum. Similar to equities. So if you mix asset classes cleverly, you get high returns and lower risk than the equity market. But we say that you should also take bets against that. So 2 points. One is you should know what the optimal portfolio is. 2, you should bet against it when the times are right. So what we show here is that optimal portfolio, what would it look like in terms of an asset mix? It's about 65% global equity, 15% bonds, a big chunk in gold, and some US cash and property, which has done very well, but at high standard deviation, high risk. Our work is to make sure that all our teams, of which there are 3 of them, fixed income team, local equities, global equities, do the work to give us an indication of what expected returns are going to come from those asset classes, and then to bet against a stale optimal portfolio. So if you look at that, we have hurdle rates and expected returns across all asset classes built from the bottom up, looking at every instrument that we analyze. This is a slide that's interesting, and it gives you some insight, because I've given a very high-level presentation today, some insight into the work we do. Our buy list has 100 stocks globally. Every single stock, we know what the intrinsic value upside is to our valuation daily. and we track that. If we can tell you what every stock is worth, what we think it's worth, and how much upside or downside there is, we should be able to tell you that for the whole buy list, which we track. So what we've done here is we've shown our buy list intrinsic value discount over time. And what you can see is when it's red, the market gives you no returns, or the buy list doesn't. When it's green, the returns are right up there, above 30%. So we bet aggressively when we're in the green space, and we bet against the market when we're in the red space. We do exactly the same thing for bonds. Some of our first slides, we showed you the bond market had a collapse in 2022. So obviously, the bond market pre that was overvalued. It had its collapse, global bonds started to offer real returns, and we started buying those, and you'll see that in the asset allocation in our fund. So that is the static portfolio on the left against our fund on the right, how it's positioned currently. And I'm just going to make one or 2 points. We're kind of neutral on equities because we're in the orange zone. Global bonds, we've been buying and selling because the market's been very volatile. It's made us a lot of money. We've been adding global bonds again now that yields have spiked higher. Cash has been a great place to invest because the yields have been there. And we had a big chunk of gold, which we've been reducing as gold prices rallied. Global property, we have felt, has been overvalued. So, putting all of that together, we demonstrated a problem. It's hard to beat the markets. You do it with tools. The tools are flexibility, structure, process in 2 areas: stock selection, asset allocation. And the proof's in the eating. We've been at North Star for 12 years. We've run a CIS offshore for about 8 years. And our goal in managing this fund was to outperform global equity managers with a flexible mandate. Now, naturally, we're operating 75% in equity. We don't have 100% exposure to the market like global managers do. And we clearly did that. And what we've shown on this slide, the orange bars represents our asset allocation and how active we are in tilting those asset mixes with the very tools I showed you in the first few slides. The red line is us, and the blue line are global managers. And what you can see is there have been 3 corrections in markets. The last one is the most interesting because bonds and equities collapsed together in 2022. And we generated, dropped by 22%, a large amount for our fund because we had some bond exposure, relative to the large managers down 28. But in the 2 corrections before that, we significantly outperformed that peer group. And we think that will continue to be the case. It's not every year you're going to have a bond correction. So even in a tough market, we still outperformed the peer group handsomely. And you can see how we've matched that peer group over time. So what do you get? Using flexibility, you get outsized returns, and we've managed to cap the downside when it counts. Thank you very much.